Good afternoon and welcome. I am Roy Campbell, and I am pleased to announce that I've recently joined Aspen in the capacity of Investor Relations, working closely with Stephen, Sean and Sanela Siwe. It is good to be on board, and we look forward to interacting with many of you going forward. This afternoon is an opportunity to engage with the market and to walk you through a transaction that was announced on the 29th of December, being the divestment of Aspen APAC. Stephen and Sean will take you through a transaction overview, the rationale, and some key focus areas. There is an opportunity to ask questions if you can submit that via the webcast. Please include your name when you do that, so we know where it comes from, and we can follow up on that. We look forward to interacting. We'll deal with that after the presentation or later on in the presentation. Thank you again for joining us this afternoon. I'm going to hand it over to Stephen to open up the discussion. Good afternoon, Stephen.
Good afternoon. Good afternoon, everyone. Becoming a bit like those family meetings with Aspen. We take curveballs, we give curveballs, but it's all happening. It's certainly no lack of excitement. But if I think about this APAC divestment, I've almost got to go back 25 years. In 2001, Gus and I arrived in Australia. We were in our 30s, and we had a check of 10 million rand, and we bought some products, and we thought we found two people, Trevor and Greg. Trevor was still with us, and we bought two laptops, and we thought we were really smart, and we were going to do something big in Australia until we came back home, and every analyst on the other side told us, every South African company fails. There's no reason why you shouldn't fail. Every company fails. And we got put under such pressure that we never expanded the business beyond two laptops and two people, and we outsourced everything in case we had to leave in a hurry. So it's quite a story to come here and tell you that actually that little 10 million has grown to 26.5 billion rand. And for many of you, you're used to either putting a B in or an M in after the numbers. And so these are things that you do every day, and it's just a spreadsheet. But for those of us who started with zero, it's quite hard to conceptualize what that number means. And I had to put it into a way that only I could understand. If we were running a Who Wants to Be a Millionaire competition at Kings Park Rugby Stadium, and we had 26,500 people there. That's a lot of people. The stadium's pretty full. And we were running the competition. We could actually say to each one of them, guys, we can make each one of you a millionaire. And being the type of analytical person I am, I try to work out if we announce each person in a minute, 1 minute between giving each person his $1 million, it would take us 18 days and 18 nights. And that started with one little trip, a little suitcase, and a very small relative amount of money. So an unbelievable achievement from what was an incredibly asset-light start, because on day 2 we lost both our laptops. They were stolen, and that really made us think twice about why we were there. But I'm glad we stayed the distance. Sean will take you through the financials on the business, but I do just think before we start and go into all the numbers, I've got to stress that Australia is a tough market, but our team there has proved tougher. I can give you a resume of their achievements. In the course of their history, they became the largest generic company. 1 in 5 of every medicine dispensed in Australia was an Aspen product. Think about that. See 5 people in the chemist are getting an Aspen medicine. We also have to, we found that regulations it tightened up quite a bit in Australia, and it became quite a tricky market from a pricing perspective. Our team adapted, they divested products, they changed course. And the last 5 years have been particularly tough as the team tried to pivot towards OTCs. But they're a determined team, and they built a business that was a top 5 OTC company. And I've really got to congratulate Trevor and his team on all they've achieved. I mean, from a startup to 26,500 million. Incredible, an incredible achievement. And for everyone, I mean, a lot of it came centrally, but so much came from the team on the ground. So well done. You're going to get all the numbers. I want to talk to you beyond commercial, and I will speak to you a little bit about our growth drivers, etc., at the very end of the presentation. But if I go beyond commercial only, I'll tell you why this transaction makes sense. I think Aspen has achieved much of what we can achieve. I think it's a chance for a very good team in APAC to enjoy a singular focus. They're likely to become a central team, a head office team, and from which that they're likely to expand from. So I say good luck to the team for their next phase, and thank you for all you've done to achieve what has been achieved in the APAC region. Really, congratulations, and thank you to all of you. And with that, Sean, I'm going to hand over to you, and you can take the people through our 26,500 million, what it looks like. Thank you so much. Thank you.
Yeah. Good afternoon, everyone. Thanks for your attendance and support today at this very exciting juncture of Aspen's evolution. What I'll do first of all, just take you through the presentation outline, give you a sense of what we're going to cover, and then we'll go into the details. So we're going to cover the overview of the transaction. We'll talk through the strategic rationale and the timelines for the transaction. And then I'll hand over to Stephen, who will talk to you very importantly about the group's growth drivers and the heightened focus on that. And we'll end the session with a Q&A session. And just please ensure you follow the protocol as mentioned by Roy earlier on in the presentation. So if we then flick to the transaction overview, I think the words that you must, if you forget everything I've said, just remember these words. It's a very compelling value proposition. I think that's the key thing that we would like to leave, or the imprint that we'd like to leave in your head this afternoon. It's an absolutely compelling value proposition. And we'll take you through all the building blocks to prove that statement as I go through the detail. From a transaction summary perspective, the transaction involves the sale of 100% of the APAC entities and the related intellectual property. The gross unadjusted consideration is 2,370 million AU dollars. In ZAR, that's just under 26.5 billion ZAR. That's at the spot rate on 24 December, which is the date we announced, 24 December when we did the deal. So sizable value. Importantly, on this transaction, there are no deferrals or earnouts. So there's nothing that we have to do in the future there will be a clawback. From an overall multiple perspective, it represents an enterprise value to normalized EBITDA multiple based on FY25 EBITDA multiple of 11 times. However, I'd like to just pause there, and if you reflect, and those of you that watch exchange rate, the Australian dollar has taken a heavy beating probably over the last 9 to 10 months. So if we'd done this transaction based on historical AUD rates, the multiple would have been way ahead of the 11 times that we speak about today. It is an opportunity to realize a compelling value for Aspen APAC. If we look at the multiple, it's 11 times. We take the group's enterprise value multiple based on the historical EBITDA for FY25. I think we were around 7.6, 7.7 pre the transaction, and post the transaction around just over 8 times. So still well below the multiple that we've got for this specific deal. So you can see the compelling value and the fact that it's way above our current enterprise value for the group. When we look at the proceeds, the net proceeds for this transaction will be used primarily to reduce debt, and importantly, it will be able to enhance our balance sheet flexibility and give us optionality in future capital allocation strategies. In terms of the transaction, we will have the standard contractual adjustments for debt and working capital. We do not anticipate these being material at all. They are pretty standard based on the movement from signature date to effective date. From a transaction and other related cost perspective, we see that value coming in at less than 5%. So I know those of you are interested in what we think the net proceeds are going to be. So based on a 5% or less than 5%, it will be the net proceeds will be in excess of 25 billion rand. If you then look to the right, we've got two pie charts there. We've got a revenue pie chart and an EBITDA pie chart. These pie charts represent the numbers for FY25. What we have done is we have put them into constant exchange rate, bearing in mind there's been quite a lot of volatility in the rand and the Australian dollar and all the other currencies over this last period. So putting those into constant exchange rate using the November 25 5-month year-to-date average, that's where we've come up with these numbers. So looking to the revenue, you can see that APAC, if you look at the top right, APAC is the turnover for FY25 is just under 7.8 billion, and it makes up about 18% of the revenue of the group. When moving down to EBITDA, the APAC EBITDA is 2,445 million, making up 26% of the group. If you look to the left and you look at the group EBITDA, you'll see our reported EBITDA in brackets there, just under 9.6 billion. However, if you look at that number in constant exchange rate, it comes down to 9.3 billion. So you can see that the exchange rate does have quite an impact on our reported results, and so we wanted to give you a sense of the potential dilution on current rates. However, very importantly, if you look to the Australian reported number on the right, so the 2,445, and then you've got the 2,603 reported, you can see that more than half that dilution actually comes purely from Australia. So a lot of the dilution in our overall group number is specific to the Australian dilution. I think another important point to note is that, as all of you know, we had a very lower manufacturing performance in FY25, and that reduced the mix of manufacturing profit relative to commercial pharma profit. So as a result, commercial pharma and then consequently the Australian business have a higher profit weighting from an EBITDA perspective relative to the group. All right, I think then I'll move on to the strategic rationale. In terms of this, coming back to the word that I mentioned earlier on, compelling value, the first thing is this is really a tangible demonstration of the value created within the group. I didn't copy Stephen's notes, but the two things that stuck in my mind, and obviously, I've also been around a while, but the two things that stuck in my mind from a value creation perspective, we've developed a very strong, consistent management team in the APAC region, and that doesn't come without a lot of hard work. And you've heard Stephen mention all the things they've achieved over time. And a very important milestone that they did achieve, and we saw that in Stephen's presentation in the FY25 result, was a shift of our OTC sales mix, an increase of that, de-risking that business from pricing pressure. So you just take those two examples, the strong management team and the shift towards OTC, just two examples of the value creation on top of what Stephen's already mentioned at the start, where we started this business. I think I was also in my 50s, so I think Stephen and I are pretty similarly aged. Although I might look old enough, my beard's a bit grey. The next point to make of this is very consistent with our group strategy of unlocking the sum of the parts. You'll recall from the first slide, the multiple for the Australian business, 11 times. It's way in excess of our group enterprise value. So we are firmly of the view that the sum of the parts of this business way exceeds the current market value of Aspen. And this is not a new theme. I mean, you go back to our FY25 results and you read through it, the theme that resonates throughout that presentation was the value unlocked in terms of sum of parts. That's a critical part of driving this compelling value. Very importantly, the next pillar is balance sheet flexibility. With this deal, it does improve that flexibility, and it does give us the opportunity to look at our future capital allocation strategies. We'll obviously wait for this deal to bed down, obviously reduce our debt levels, and then we'll reconsider our capital allocation probably after the end of FY26. From a foundational perspective, it gives us a very enhanced foundation to deliver on our strategic objectives, to drive value and returns for shareholders, and that's a key thing. We really want to drive value and return for our shareholders going forward, and that's something that's top of our list. And then a real important lever here is the reduced debt levels will materially lower our financing costs. So if you remember from our first slide, we anticipate net proceeds of north of 25 billion. If you remember from my presentation at the end of FY25, I think our interest rate at that point was 4.9%, and we guided that it would come down by at least 30 basis points. If you apply the 4.6% to that, it'll give you a sense of what the interest saving is, but it's way more than R1 billion, and it'll pretty much wipe out most of our interest bill going forward. On the growth drivers, this transaction doesn't enable us to have a much more heightened focus on our growth drivers. I'll just cover the key headings here. I think these aren't new growth drivers. We've been pushing these hard for the last 12 to 18 months. First one being the sustainable organic growth in commercial pharma. The second one being the reshaping of our sterile FDF manufacturing facilities, which includes commercialization of contracts, vaccines, and GLP-1 generics. Very importantly, a focus on stronger free cash flow generation. I won't steal Stephen's thunder. He's going to cover those and other strategic factors in a lot more detail in subsequent slides. Onto the anticipated timelines. We have got JSE dispensation to publish the circular to shareholders by the 20th of March. Assuming that that's the date we do publish, the shareholder vote will then be on the 22nd of April. Should we achieve an earlier date of posting the circular, the shareholder date will then move accordingly. Based on these dates, we anticipate this transaction completing at the end of May and then moving forward. On that note, I'm going to now swap chairs again and hand over to Stephen for the strategic growth drivers. Thank you.
Thank you, Sean. Okay, I'm going to just before I touch on the growth drivers, I'd like to just go back to the point on sum of parts. You know, the one thing that Aspen hasn't been shown, so let me be clear, we've never ever asked a shareholder for 1 cent. We've never done nothing. Please understand how we built Australia, how we built the whole of Aspen. We've never issued a share to a shareholder and said, please, we need financing that. But with all that said, we've never been shy on corporate activity over the years, including numerous divestments. I cannot think of one, and we never sold the family silver in any of those divestments. I cannot think of one we didn't do it at a double-digit EBITDA multiple. And over 20 years, there's seldom if ever I've commented until last year on a mismatch between the share price and what the underlying assets in the business look like. And I've left that to others to do because I don't think that's my job to do. But it seemed so disparate to me that I raised the sum of parts issue. And I said there was a clear mismatch. And I want you to say it too, because ultimately I bought a lot of shares afterwards. But we've got valuable assets, and I've got to stress to you, we keep demonstrating in commercial pharma and in manufacturing. And we told you we would consider a value unlock if we got fair value for some of the assets we considered. And this is a demonstration of we have fair value, and we have considered it, and we have accepted it. And I just want to add that even at the current price today, we're still well short of what the balance of the sum of parts are. And have a look at those growth drivers. They are not in this area predominantly. And we will continue to look for ways to unlock this value. Turning to the growth drivers themselves, I was very clear, hopefully in the last presentation. I mean, we had such a curveball hit us that we weren't anticipating. And you know, sometimes in life you get those things. And from an Aspen perspective, it was very sad at the time, but it's really helped reshape the group, and it's helped give focus. And you know, we're not a team that's scared to roll up our sleeves. And maybe we got a little bit away from rolling up our sleeves, but we've rolled up our sleeves. And we just simply went back to those areas that we could control. And that's where our focus was. It was to deal with the GLP-1 opportunity we created. It was to fix China, to reshape our manufacturing because and to realize and commercialize contracts and the capacity we have. If I go to the commercial pharma growth drivers, let me be very clear. Aspen has taken a very big bet on GLP-1s. We've added, but maybe before I start, let me talk about China. China is a reshaping, but it's not going to necessarily give us growth in turn. All we've done is we've turned it into something profitable. We've still got to work on a strategy to grow that profitability. It's not a drain on the business. We've had to deal with all sorts of GLP-1s, cancelled products, but it's a very nicely profitable, and it will contribute very well to our into this financial year's profitability. But in terms of growth drivers, future growth drivers as well, not just for 1 year, we took a really big bet on GLP-1s. We allocated significant capital to develop product, to try and get to market early, to be at the forefront, to have the right manufacturing capabilities. All of this took a lot of time and effort and human resource. So let me give you a little update of where we are because there's been quite a lot of movement. On the semaglutides, the shake-up's going to come in Canada. Whoever performs there is likely to perform across the rest of the globe. It's public knowledge what I'm telling you now. We're one of a handful or less than a handful of products we're in the shake-up. Bottom line, we're in the shake-up. We might be first, we might be fourth, but we'll be there for market formation. The patent goes in January. In our opinion, and having dealt with the regulators, nobody's coming to market in January, and it's highly unlikely anybody's going to come in the first quarter of the calendar year. At best, we're going to see 2 tour launches, and I'm really proud of what the team's achieved. There's no doubt that we're going to be in the shake. I can't tell you we'll be first or fourth, but we know we have a dossier that's registrable, and we're in a good position. Mounjaro, which is our other GLP-1, the brand Mounjaro, which we've got from Eli Lilly, it's absolutely shooting the lights out. I can't tell you anything out. It's way beyond. It's reached number 1 in the market. And the market's growing. It's whatever numbers we've shared with you, and we'll obviously update you in our half-year results. But whatever numbers we gave you, it's wrong, and we've missed by a massive margin. On the positive side, sorry, just to be clear on that. And I think 26 calendar year is a very big year for us there for a couple of reasons. One, we're getting a whole lot more stock. We've been battling to get our stocks in, and we're getting a whole lot more stock in. It's arrived. And we start our regulatory process and registration process in Africa. Remember, we haven't just got South Africa, we've got Sub-Saharan Africa, and we start those launch process and expect the turnover and registrations in 26 calendar year, and hopeful that will also be a very big growth driver for Aspen. So yes, we've taken some big bets in this region, and we're confident that we're going to get some strong delivery out of it. Under manufacturing, we talk about reshaping the sterile facilities and to get them to break even. So let's understand what we're actually saying here for financial year 27. We're saying we've got embedded in our 25 numbers is a positive on an MRA contract of 1 billion rand. So we've got to make 1 billion rand more just to get back to where we were last year. And we've got sterile losses in our business, which would take us to sort of over 2 billion rand of losses that we are saying. So what we're saying to you from the position we're in now, we need to get 2 billion rand. If we achieve a break-even zero, we would have delivered 2 billion rand. And how did we say we were going to achieve it? Once again, the things in our control, reshape our facilities and do the contracts. Now, reshaping facilities, it's been, you can never be certain. You're never certain how things are going to come out, etc. And it's been a really, really tough 6 months. And for us, reshaping an Aspen environment is really painful. It's difficult and, to be candid, an incredibly stressful process. From that perspective, I'm happy to tell you that we have successfully accomplished most of what we hope to achieve. And we're more than 90% done as I speak to you now. Under contracts, we've made progress with our insulin contract out of South Africa. That's a big swinger for us to get to the numbers as well. We've started commercial production. What does that mean? It means Nova and Aspen are comfortable that we've had the regulator come to our factory. We're pretty comfortable. We're in a good space that both parties feel they can go into commercial production. As soon as the approval is received, we can start releasing stock, and that approval is expected during Q1 of this calendar year. The others are the vaccines, and it was almost like this is scripted, but we've had the serum, the pediatric vaccines. We've now had 2 products registered. In fact, the one I just got a message about an hour ago, and those 2 are rotavirus and PCV. The PCV has been registered by SAHPRA. And so that's positive for us because SAHPRA is a South African agency. To be able to submit to WHO, we first have to get SAHPRA approval, so we've got that. We're hopeful that WHO will have a fast-track approval now with us. But even if they don't, we are no longer dependent on. There's one big block tick, having registration under your own regulator. I think we should also expect some positive GLP-1 impacts on volumes as they come into both of our factories. When I spoke to you last, I apologize, but it was the truth. At the time, it was an incredibly negative time for facilities, particularly our European facility. There was a lot of uncertainty on tariffs at that stage. It was 100, 200% if you made in Europe, and particularly to take European manufacturer into the US. I'm happy to say that, that's settled now. There's settled tariffs. The environment is more benign. What you're seeing, by the way, is people are becoming a lot more nationalistic about where you manufacture, and people in Europe want their products in Europe. There are a lot of multinationals in Europe. There is a lot of production that's being installed in the US, but there are a lot of people now who say, well, we better make in Europe as well. So we're starting to see a movement where there was none. So that is positive for us. Just trying to think if there's anything else I've left out there. I think that's it. And, and we'll keep you appraised as we move along. In terms of, the WHO timelines, etc. Please don't ask me any questions. Literally, I had an answer an hour ago. As soon as we know if we're on a fast track and we're slow track, we'll give you updates on those as well. Under free cash flow generation, there's been a lot of focus here. We've always had a very strong operating cash flow conversion, and that's great. However, we've had more CapEx than depreciation, and working capital has increased a bit, which has meant we've always had pressure on our free cash flow. Sean mentioned to you in the last presentation that there's a desire to get our depreciation, our CapEx to match, and to have simply a lower working capital in absolute terms by 27, 28, and that would unlock our free cash flow. That said, Sean, I don't know, the 27 years, I'm going to leave one last thing to you. We're getting a whole lot of money in. We've got a debt burden. We've got a total debt that's not looking too bad. And I mean, I'm going to leave you that by the end of this year, we get to a situation where the first time in our history, we have net cash. We're a company we've never taken from our shareholders. We've taken from banks. And that's your best way of telling if a business performs or not. I mean, you can give me any formula you want, but if you can take money and pay it back, it can be hidden in taking capital from others. But nothing's hidden in Aspen, so you get all the surprises, the bumps and lumps with us. But Sean, I think I'm going to leave it to you to get us into a net positive by the end of the year. But thank you all. Thanks for your patience with us. And it's an exciting journey for us. And as a group, sometimes there's quite a lot of momentum behind us at the moment, and we're moving forward positively. Thank you. Roy, I think that's all I've got to say. Anything else I should have? Okay, that's cool. Thank you.
Thank you, Stephen. Thank you, Sean. Thanks for the presentation. So we've got a couple of questions that have come in. I'll just go through them. Some of them are repeats. Some might just be we'll just shoot them off and get answers. And some of them are asking quite a lot about margins and what the impact is going forward. So we've got to be careful of guiding over here. But let's just start with Anda from Standard Bank. She's got 5 questions, around about 5 questions. Quite detailed. Just wants to know the EBIT contribution from APAC. And there is the 18% revenue, 26% EBITDA, and EBIT contribution. I don't know if you've got that on hand, Sean, or we should get back.
No, I think you can apply a similar number at the EBIT level.
Okay. Talking about GP margins post-deal, I don't know if we are able to talk about GP margins post-deal.
I can talk to that. I think the Australian GP margins are lower than overall group margins. So from a GP margin perspective, there should be a bit of an uptick. But from an overall EBITDA margin perspective, the Australian business does have a higher EBITDA margin, especially from an expense perspective. So from an EBITDA margin, they are slightly higher than the manufacturing. And manufacturing obviously has dragged us down as well. And also they've had some impact on manufacturing as well.
Are the manufacturing facilities in India and Australia included in the deal?
The manufacturing facility in Australia is very much commercial pharma facing. So it's very, very, very low third-party facing. So I think the third-party business for Australia is purely to service overheads, but not India at all. Only the Australian factory.
Okay. The 1.16 profit after tax for APAC you're referencing, you're saying, does that exclude China?
Yes.
Okay, and I think we've covered that. Then Alex from JP Morgan, are there any raw material supply contracts, and are these at market prices? Secondly, the net after-tax amount cash that you expect to receive. And again, why did you not exit China as well?
I think in terms of the net after tax, I think Sean gave you back this, that it was less than 5% of that would come out of the sum. Why didn't we exit China? China doesn't fall under that management team. China's always had a separate management team. So that team went with the region that they manage. I can't remember the first question.
What was the first question, right?
The raw material supply contracts.
Yeah, so we do have supply contracts, but then they are not. There's no loss from those contracts. We often have products that are the contracts with Aspen, or we've often got common products, so it's very good to have the absolute volumes. But there's no onerous contract or onerous supply or anything like that.
A couple more from Alex. Any plans for share buybacks, and what are the interest charge and tax rate going forward?
So, I mean, the interest charge, I mean, you can see we're going to extinguish most of our debt. So from there, it might be what forex losses, and it might be on the finance charge. So, I don't think there's material shift in tax, Sean.
No.
In rates and capital rates. So there's one question. What question did I leave out?
Any plans for share buyback?
Share buybacks. I think we've got to look at where our share price is, and if we believe that the sum of the parts is so much, we'd have to look at what we reallocate that capital. But for now, our absolute focus is we spent a lot of time just focused on getting this transaction done. It was actually most of the work was done on it was Christmas in Australia. It was the day before here. So all focus was on getting the transaction done, and we're going to sit, chat to the board, and decide how we allocate capital and what's in the best interest of shareholders.
Peter Konoff from Alan Gray. What are your priorities for balance sheet flexibility? Is large M&A likely, or returning cash to shareholders, or something else? Do I understand correctly that your guidance or ambition for sterile manufacturing to be EBITDA break even by FY 2025?
We'd like to be more than EBITDA break even. We'd like to be EBIT profitable.
Yeah, cash flow.
Cash flow positive. Thanks.
By FY 2027.
By FY 2027. I think that we're not looking at any M&A or massive M&A or acquisitions. Right now, we've got really strong growth drivers in our business. We put a lot of capital into our factories, and we put a lot of capital into GLP-1s. We're starting to see benefits from both, and it's only the start. We want to see the growth, and those growth drivers, we hope in time will substitute for what we have, for what we've divested out of Australia. That's where our full focus is, Peter. We spent a lot of money, and we want to get returns on that money that we've spent, and we're seeing a path.
Thank you, Steve. Patsy is asking, you may have covered this already, Stephen, in your talk, just insights into reshaping of manufacturing in terms of progress in GLP-1.
I think I've said everything I want to say on that. I think I've covered that.
You've covered that, yeah. Loyando from Nedbank. Organic growth within the commercial pharma is historically 3-7. Now that APAC is sold, what would be the growth rate?
I think the growth, Australia has been a drag on growth relative to the base. What remains should have a higher growth rate than what we had before. I'm not going to say it's 3 or 7 because, we've got quite a few impacts at the moment, with GLP-1s and shifting things up. I think, you can probably take Australian turnover out of the business over the last 4 or 5 years. It's easy enough to work out, and you'll see that, you'll see what those historical trends look like, and I think those could continue, and hopefully a bit of a kicker now with what's happening on Mounjaro.
I think some questions, including from Quinton Ivan at Coronation, another one for Loyando, all dealing with whether the entire proceeds will be used to deleverage, and I think that you've covered that in the presentation as well. Just looking through here and refreshing just to see if there's any others that are going to come through. Just give me a second. Etienne at Truffle, could we expect more transactions like this to unlock value? Will you be actively looking for similar transactions, or is this opportunistic? Will the value creation come more from organic improvement contracts, GLP-1 going forward?
I think I commented when I spoke about some of the parts that I felt that the assets are still undervalued, and to the extent it stays that way, we would keep looking to see. We would continue to follow the same path we have. It's not new. It's not a today or last month. We've done this over years. The gap then, when we told you, and the gap today is still so high that unless there's a major shift, we would continue to have to look at those assets where people think there's a value, where we see a value arbitrage. Clearly, it's very helpful to be able to have the tailwind behind you. It's good to have a tailwind behind you in terms of sort of the GLP revenues and reshaped facilities and contracts coming on. That's at least we know we can tell you a contract, it's fine, we either get it or we don't get it. Our focus is what we can deliver, but we will if the opportunity comes. We're open to the opportunity. Not saying we're not close to this opportunity. If there's an opportunity to unlock, we will.
Thank you, Steve. So Andre Becker from 91. Good day, Stephen and Sean. 3 questions over here.
Yeah, I'm not getting us once, eh? How many more questions to go? I'm getting thirsty here, right?
It's tricky because the writing is small as well. I'd like to unpack the net cash comments. What is your intention to run the business on a no debt going forward? And where does Aspen's some of the parts strategy rank in capital allocation?
It's certainly no one here has had a discussion that we're going to say cash positive. It's not a discussion. So, you know, we're not looking to create unnecessary debt, but you might, you know, we'd have to have a look. And we, as I said, just give us a little bit of breathing space to come back to capital allocation. What we know for sure is we're going to reduce our debt, and then we've got to have a good look at where things settle and decide where it goes, you know, how else we get returns to shareholders. But what I can tell you, there's no acquisition in the wings that's waiting to have this money allocated.
Thank you. So Fergus from Sultana, also 2 questions. I think that you have probably covered this, both Sean and Steve. The first is just around the GLP-1, the change in industry dynamics in Canada. And second, high level is why not focus on divesting more dilutive assets in more expensive jurisdictions from operational perspective?
I think we've covered that. Yeah. We look at each asset and decide how it fits and whether it fits and whether we're getting value for it. It's something you simply can't sell. It's the heart and soul of the business. And even a compelling price is not compelling. So, you know, we just got to assess each option on its merits.
I'm just going to ask my esteemed colleagues in LSE if she's spotted any more questions here that we need to get to.
Gavi launch timing for
Alex has some more questions. Do you have the timing of Gavi vaccine launch?
I specifically asked, I've only got the PCV registration and our report, so I've asked specifically, just give us a little bit, you know, let's go and consult with the team, let's consult with WHO. As soon as we have timelines, and that's great. You know, we waited 3 years for the registration, so it's been a long period. So we finally can say that is one block that's speaking to tick. Okay, well, good. So if there's any more questions or any of those that you want to, I mean, we can just direct it to our team and get a response. But thank you for the interest, and thank you for being on the line, and we'll be talking soon. I think we agreed our results.
The results will be 3rd of March.
3rd of March.
Presentation
4th of March. So we'll talk to you then, and we can give you an update on all of these other areas.